I'm Mark Roach, and this is FutureWise Energy, an innovative voice, an independent upstream energy platform supported by individuals, where I share my views developed across cultures, technology, operating oil and gas fields, executing M&A, as well as leadership and startups. I draw from a wide range of personal experiences from over 30 years in the industry. The rig count tells one story. Production tells another. And sometimes the disconnect between the two reveals everything that you need to know about where value is actually being created. As we close out October 2025, WTI sits at about 60-64 per barrel. Brent at 64.74. That's down 17 to 19% year over year. Not exactly encouraging if your business model depends on $70 crude. Yet U.S. production just hit an all-time record of over 13.6 million barrels per day for the week ending October 17th. The oil-directed rig count, well, it's down 62 rigs from last year. I had a hard time saying that. It's a 13% decline to just 420 active rigs. Natural gas, well, it tells a different tale entirely, as I've been talking about here week after week. Henry Hub futures settled around 333 per MMBTU on October 28th today, representing a 64 to 83% increase from October 2024's $1.82. So gas rigs, they've climbed to 121, up 22 rigs year over year, the highest count since August. LNG exports are expanding. AI data centers are demanding baseload power. And EOG Resources expects U.S. gas demand to grow another 4 to 6% annually through 2030. The divergence is structural, not cyclical. Now let's talk about where the real action looks to be unfolding in the U.S., in the Gulf of Mexico, or Gulf of America, if you like. As of October 24th, the U.S. offshore rig count surged to 21 rigs, up from just 17 the previous week, and from 18 a year ago. That's a 23.5% week over week jump. Earlier in October, the count had fallen to just 8 rigs. Now, that was the lowest since September 2021. That recovery, well, it isn't noise, it's probably a signal. The Gulf of Mexico crude production reached just under 60 million barrels in July of 2025, approximately 1.9 million barrels per day. That's up about 3.3% from June and about 4.6% higher than July 2024. The EIA now projects Gulf federal offshore production will average about 1.9 million barrels per day in 2025, rising to nearly 2 million barrels per day in 2026. Now, some private forecasts call for 2.2 to 2.4 million barrels of oil equivalent per day in 2026 to 2027, which would be an all-time high deepwater production for the U.S. Now, this isn't happening by accident, as you probably well know. 2025 is shaping up as the most significant year for Gulf of Mexico project startups in over a decade. 3 major floating production units came online. The multiple subsea tiebacks added substantial capacity. These projects collectively add nearly 350,000 barrels of oil equivalent per day of nameplate processing capacity. Those are the highest additions since 2015, 10 years, over the last 10 years. Shell's Whale FPU began production in January and reached peak oil production of approximately 100,000 barrels per day within just 5 months. Located in ultra-deep water at approximately 8,600 feet. Whale demonstrates what's now possible in extreme deep water environments. The rapid ramp-up far faster than typical offshore project curves, reflects both excellent reservoir performance and operational expertise. In July, Beacon Offshore Energy started production at Shenandoah, only the second development to produce from the ultra-deepwater lower tertiary Wilcox trend using advanced 20,000 psi technology. Phase 1 is expected to ramp up to 100,000 barrels per day in the third quarter of 2025. Phase 2 comes online by mid-2026. Shenandoah South is sanctioned with its first oil anticipated in 2028. With sediment depths reaching up to 35,000 feet and crushing pressures are demanding a rare 20,000 psi blowout preventer and there's only a handful of these ultra deepwater rigs around the world that can drill these targets. Beacon's contract for Transocean's Deepwater Atlas commanded day rates, get this, of nearly $490,000 in 2021. That's the premium required for specialized equipment capable of unlocking the lower Wilcox, widely regarded as the last great untapped oil province in the Gulf. Chevron's Anchor field began producing in August using groundbreaking 20,000 psi rated equipment, a first for the offshore industry. The project has a capacity for 75,000 barrels per day of oil and 28 million cubic feet per day of natural gas. This technological achievement opens access to previously uneconomical high-pressure reserves and reservoirs across the Gulf. BP's Argos Southwest extension started production 7 months ahead of schedule, adding 20,000 barrels of oil equivalent per day through 3 new wells that were connected to BP's Argos platform. The accelerated timeline demonstrates improving production execution following BP's strategic pivot back to upstream growth. According to Rystad Energy, the 2025 startup class could contribute 15 to 18% of total U.S. deepwater production in 2026 to 2027, the highest sustained production contributions from a single startup year since 2009. The economics driving this offshore pivot are compelling. Modern Gulf of Mexico projects achieved break-evens of $20 to $35 per barrel for many developments, substantially below the $48 per barrel onshore average. Offshore fields exhibit production decline rates of 5 to 15% annually compared to shale wells that typically decline 70 to 90% in the first 3 years. Individual Gulf discoveries often hold 100 to 500 plus million barrels of recoverable reserves, dwarfing typical shale well ultimate recoveries of 300,000 to a million barrels. The Trump administration's energy policies created a favorable regulatory environment. The Bureau of Ocean Energy Management and Bureau of Land Management received exemptions from government shutdown furloughs to continue processing permits for priority conventional energy projects. The Interior Department announced plans to hold 30 offshore oil lease sale auctions over the next 15 years through 2039 to 2040, with twice yearly sales in the Gulf. This dramatic expansion from the Biden administration's 3-sale program provides long-term visibility for operators planning future exploration. Now, here's where history offers a valuable lens, and my own experience taught me a lesson about the limits of even the most sophisticated forecasting. Back in 1993, I did one of the first studies for BP using all the data from North American gas wells. I was working with Bill Sears, who was their BP's president at the time, and later we worked with Gene Ames at the IPAA. course, I was also working with Lou Powers, who was an Exxon high-ranking official at Exxon and also ran Saudi Aramco's technical business back in the 70s. And what we took on was cutting edge at the time back in 1993. We undertook about a $500,000 study to model every oil and gas well in North America on personal computers, which had just come out at the time. This was, this is before the computational power that we have today, and we kind of take for granted today. But I was running the analysis on two computers and writing algorithms for decline curve forecast of all the existing wells. And then we developed type curves for new wells based on the recent production trends in each basin. And the goal was to present credible data to Congress while we were trying to protect really American jobs at the face of international political pressures. Well, the study itself was methodologically sound, and the output was clear, but ultimately it was not successful in pinpointing the future delivery of oil from the North American gas and oil wells. Mostly because, well, not because it lacked technical merit, but we just didn't know how many behind pipe reserves existed, especially in the Gulf of Mexico. And we watched, disappointingly, Congress choosing international politics over the small oil man, and the dynamic that we've seen repeated over and over again, and to some extent even today, was kind of hard to swallow. But nonetheless, the U.S. has regained a enviable position today as an exporter. Now, but part of what I'm bringing up this story from the ancient past here today is the real lesson came later as we watched the results and tried to understand what went wrong with our projections. It became clear that our projections, rigorous as they were, had missed something very fundamental. We just hadn't, as I mentioned, adequately reflected the reserves from wells that had behind pipe zones to existing completions, which, especially from those behind pipe zones in the Gulf of Mexico, which ended up having significant contributions that materialized in the future. Our forecasts were understated, not because the math was wrong, but just those behind pipe reserves are difficult to forecast based on public data. And in the mid to late 1990s, a significant portion of the Gulf offshore output came from those recompletions and operations from existing wellbores that were re-entered to produce new zones or bypassed reservoirs that, rather than drilling new wells. And by 1996, recompletions accounted for approximately half of all offshore gas well completions, up from around 1/4 a decade earlier. That means roughly 50% of additional production volumes achieved during that period were derived from recompleted wells rather than entirely new drilling operations. These recompletions frequently restored or enhanced production rates in older wells as much as 70 to 120% of their original flow levels. So the recompletion boom that occurred when oil prices hovered near $20 a barrel and operators sought low-cost reserve additions during a period of constrained capital expenditures. Average well level recompletions in the Gulf Shelf reservoirs often boosted production by 30 to 60% of pre-workover levels in the first 6 to 12 months before stabilizing at incremental flows of 10 to 20% higher than pre-workover output for over several years. Because recompletions require no drilling days, they delivered the highest return on investment in that era's offshore portfolio. The experience shaped how I think about today's market. A similar dynamic exists with drilled but uncompleted wells, or DUCs, DUCs, and deferred hydraulic fracturing programs on onshore U.S. shale basins. Like the 1990s recompletions, these wells represent sunk capital cost and assets that are awaiting higher price signals or improved services availability. As of 2025, operators, particularly in the Permian Basin and Eagle Ford, continue to pace completion schedules based on WTI price optimization and service cost cycles. So I wonder how many wells have been drilled, especially in the shale regions that are connected with other behind pipe zones or laterals that are being brought online, or ones that have been drilled but not rushed to completion that may be propping up production in the Permian in particular, and muddying the narrative and some of the technical connections between the rig count and production rates, kind of mystifying the ability of the analyst to look forward, because the completion rig count is obscured from the is not directly tied hard to the production data. So the Gulf recompletion experience that I reflected on suggests that latent productivity capacity in the form of these DUCs, deferred laterals, and recompletion ready wellbores can deliver substantial incremental supply when economics permit. This dynamic, sometimes called shadow supply, helps stabilize production during volatile price periods. It's also a reminder that sophisticated models, no matter how advanced, can miss critical variables if those variables don't fit neatly into the framework that you've built. Geopolitically, October witnessed several significant developments. A Gaza ceasefire, that framework temporarily reduced risk premiums in oil markets. Evolving U.S. China trade negotiations could ease tariff tensions and affect rare earth mineral flows critical to energy infrastructure. New U.S. sanctions on Russia's largest oil producers, Rosneft and Lukoil, briefly spiked prices before skepticism about enforcement of effectiveness tempered market reactions. OPEC continues its gradual production increase strategy, approving another modest 137,000 barrels per day hike for December 2025, though compliance remains uneven and spare capacity concerns persist. The persistently weak price environment has created challenges for producers, particularly private equity-backed companies with oil-weighted portfolios. According to various intelligence research, approximately 1,800 shale locations held by private equity can deliver a 10% return at $50 per WTI, while 6,700 locations require higher prices to hit that benchmark. This price sensitivity has contributed to a significant slowdown in mergers and acquisitions activity, and many firms postponing exits and anticipating, while the more favorable market conditions in 2027 or later. The natural gas M&A landscape tells a different story. U.S. natural gas M&A deal value climbed to approximately $30 billion in the first 9 months of 2025 from 22.5 billion a year earlier. Notable transactions include Asian firms targeting Haynesville Basin to secure feedstock for LNG imports, with JERA, Japan's largest power generator, completing a $1.5 billion acquisition of South Mansfield assets from GeoSouthern and Williams. More than $28 billion in gas and LNG assets are currently up for sale. Looking ahead, the Gulf of Mexico project pipeline remains robust, with 13 new fields expected to start producing during 2025 to 2026, including 8 subsea tiebacks and 4 new FPUs. Major sanctioned projects moving forward include BP's Tiber Guadalupe, a $5 billion development with final investment decisions approved in September 2025 for a floating platform expected to produce 80,000 barrels per day starting in 2030. The development will tap 350 million barrels of oil equivalent from the Tiber and Guadalupe fields in deepwater lower tertiary. This represents BP's largest Gulf investment in years. What we're witnessing is a fundamental shift in U.S. oil industry's growth strategy away from maturing onshore shale plays toward deepwater offshore developments with superior economics and longer production profiles. The technological capabilities now available 20,000 psi equipment, subsea boosting systems, extended reach drilling, AI driven reservoir management, continually unlocking previously uneconomical resources. Capital intensity remains a constraint. Deepwater projects require $2 billion to $10 billion plus upfront investments with 3 to 7 year development timelines before first production. Hurricane risk adds operational uncertainty. Specialized equipment constraints with day rates of up to almost, half of $490,000 a day for ultra deep water rigs. Well, that can limit project schedules. But for well capitalized majors and large independents with long investment horizons, the Gulf offers a rare combination of scale, predictability, and returns that shale increasingly struggles to match. The rig count by itself is no longer a reliable indicator of where production is headed. Technology, efficiency, project pipelines sanctioned years ago, latent capacity and drilled but uncompleted wells, recompletion opportunities, all of these factors now matter much more than the number of active rigs. The market isn't shaped by what's being drilled today, it's shaped by what was sanctioned 3 to 5 years ago, what's waiting behind pipe, and what operators choose to bring online when prices justify the economics. The disconnect between the declining rig counts and the rising production isn't a paradox, it's the new normal. Understanding that distinction is what separates those who react to the headlines from those who anticipate the fundamentals. I'm Mark Roach, and this is Future Wise Energy, wishing you all the best.